Hello, this is a recording on FIN4802. I'm going to be looking at study unit 3 in this recording. So we've been going through the study units in this module, and to date we've covered the first 2 study units. So in the previous recording, I looked at the international flow of funds, and study unit 1 was mainly an introduction. So in this recording, I'm going to take you through study unit 3, international financial markets. In this study unit, we'll start coming across some of the important terms that will be used later on in this module when it comes to some calculations we'll be doing involving exchange rates. Okay. So the first thing you need to know in the study unit, you need to know about what we call the foreign exchange market. Now, the foreign exchange market is a market in which individuals in a particular country, mainly banks and financial institutions, can buy or sell foreign currency. Okay. So the foreign exchange market allows for the exchange of one currency for another. So it allows the exchange of rands for US dollars or pounds for euros and so forth. And in this foreign exchange market, we sometimes call it the spot market, right? There's what we call the spot market, which falls under the foreign exchange market. And the spot market involves the purchase or sale of a foreign currency today, okay? There's also what we call the futures market, which I'll talk about later on in this recording. And the futures market involves the purchase or sale of a foreign currency sometime in the future. But you'll understand that further as we go along. So when we talk about the spot market, this involves the immediate exchange of one currency for another currency at a rate we call the spot rate. So if you go to the bank and you require foreign currency, maybe in the form of US dollars today, and the bank tells you that $1 is 17 Rand today, we call that a spot rate. And the transaction you're conducting with the bank will be occurring in the spot market. So this transaction of exchanging one currency for another, in effectively buying or selling one currency, it's said to take place in the spot market if it happens today. Just like I'm saying, there's what we call a futures market. That's when you're entering into a contract to buy or sell sometime in the future. But I'll explain that later on in this video. Okay. So at any given point in time, when a bank wants to conduct a transaction in foreign currency, not just a bank, even any other financial institution, at any given point in time when a bank or any other financial institution wants to conduct a transaction in foreign currency, right, we look at 2 values. The bank will have 2 values that they need to look at. They need to look at what we call the bid quote, and they need to look at what we call the ask quote, right? So the bid quote is the price that banks are prepared to buy a foreign currency at. So the bank will approach the foreign currency market, and they'll be prepared to pay a certain amount of money for the foreign currency that they want. For example, the South African bank might go into the foreign currency market, foreign exchange market, and they might be prepared to pay 17 Rand for each US dollar, right? But there'll also be an ask quote, right? There'll also be an ask quote, just like banks want to buy maybe at 17. Let's say someone wants to buy a currency from the bank, they'll be prepared to buy at 17 from the person. Likewise, there's also what we call an ask quote, and this is the price that banks will be prepared to sell a foreign currency at. So you might find that the banks might actually be asking for 18 Rand per US dollar, South African banks, whereas when they're selling, they might be asking for 18 Rand, and then when they are buying, they might be prepared to buy for 17 Rand. So there's a small difference there to cover their expenses or to also help them to make a profit. Okay, so the difference between those two, between what banks are prepared to pay to buy it and the price that banks are prepared to sell it, the difference between those two is known as a bid-ask spread. It's known as a bid-ask spread, and it represents the differential between the bid price and the ask quotes. And the price that banks are prepared to buy it is always lower than the price that banks are prepared to sell a foreign currency at. So we can look at an example from the prescribed textbook just to illustrate to you how we could calculate what we call a bid-ask percentage spread. Like, let's say we want to understand the difference between what banks are asking and what banks are prepared to pay, right? So let's say we want to find out the difference between that. So this example says, assume that the prevailing quote for wholesale transactions by a commercial bank for the euro is 1.08.76, right? So you'll find that the bid-ask percentage spread can give us a measure of the difference between what banks are bidding and what they're asking. So here's an example. So let's say for the British pound, so we're assuming we have an American bank here. Let's say for the British pound, an American bank is prepared to pay $1.52. And let's say they are selling a British pound, they're prepared to sell a British pound at $1.60. So we can calculate the bid-ask percentage spread as the ask rate of $1.60 minus the bid rate of $1.52 over $1.60, and then that can give us a bid-ask percentage spread of 5%. Likewise, we can assume that an American bank is prepared to buy one Japanese yen for 0.07 and sell one Japanese yen for 0.074. And then likewise, we can substitute again and we can get the bid-ask percentage spread. So you might be asked to calculate this in the exam. So make sure you're comfortable with that. And then you also need to know about what we call direct and indirect quotes when it comes to foreign currency, direct and indirect quotes. So a bank or any other financial institution that is involved in exchanging one currency for another will quote the price at which they can buy a currency and the price at which they can sell a currency. Okay, so these quotations in a foreign currency that represent the value of the foreign currency in dollars or rands. Okay, dollars if you're an American bank, rands if you're a South African bank, but you know that most international banks use dollars. So let's say we want to quote how much a foreign currency is worth in our domestic currency. We call that a direct quotation. So a direct quotation, if we're a South African company, this gives the number of rands per currency. Or if you're an American or international company, it gives the number of dollars per currency. For example, this would be an example of a direct quote. If you go to the bank or an exchange house and they tell you that 1 pound is equals to 23.33 Rand, they are telling you how much 1 unit of the foreign currency is worth in terms of the domestic currency. Okay, so 1 pound being worth 23.33, this would be an example of a direct quote. This is another example of a direct quote, but applying US dollars. Let's say you're an American company and you're told that 1 pound costs $1.23. So a foreign currency, in this case being the pound, is being quoted in terms of the domestic currency. In this case, South African rands if you're a South African company. And in this case, US dollars if you're an American company. So we call this a direct quotation. Okay. But alternatively, quotes can also be represented as indirect quotations. And quotations that represent the number of units of a foreign currency per 1 unit of the domestic currency are referred to as indirect quotations. For example, if we say that 1 rand is equals to 0.0435 pounds, this is an example of an indirect quotation. We're taking the domestic currency and then we're saying it's equal to a certain amount of the foreign currency. Okay, so this would be an example of a direct quote if we're a South African company. So whenever you want to get an indirect quote from a direct quote, you simply take 1 divided by the direct quote, and that gives you the indirect quote. Okay, so I can illustrate that to you through an example. So the opposite would also apply. If you want a direct quote from an indirect quote, we just say 1 divided by the indirect quote to get the direct quote. So there's an example that can illustrate how this can actually apply. Here's an example. The spot rate of the euro is quoted this morning at 1.031, meaning 1 euro is at $1.31 US dollar. So we're assuming we have an American bank. This is a direct quotation as it represents the value of foreign currency in dollars. The indirect quotation for the euro is the reciprocal, meaning we just divide of the direct quotation. So to get the indirect quotation, we would just say 1 divided by the direct quotation, where the direct quotation is 1.031. This is how much 1 foreign euro, a foreign currency, is worth in dollars. So we say 1 divided by that amount, and we get 0.97 cents. So that would mean that 1 US dollar is actually worth 97 cents in euros. Okay. So the opposite would apply if we want to get back the direct quotation from the indirect quotation. We just say 1 divided by the indirect quotation, and that gives us the direct quotation. So that's an important distinction of how you can change indirect quotations and direct quotations. Okay. You also need to know about what we call cross rates. We also have what we call cross rates. And cross rates are a way of determining the exchange rate between 2 foreign currencies. Okay, so let's say we are in South Africa and we want to know the exchange rate between the British pound and the US dollar. We can use cross rates to help us to determine what the rate is between the British pound and the US dollar. And we can determine these cross rates using what we call direct quotes in the domestic currency. So we can take those direct quotations we were talking about, and we can use them to determine cross rates. So for example, let's say we're told that 1 US dollar is equals to 18.9136. So this is the direct quote. We're a South African bank or South African financial institution, and we're given this quote. And likewise, let's say we're told 1 pound is equals to 23.3187 pounds, right? So it rands 1 pound. So these are the direct quotes for a South African bank. Let's say we want to quickly determine what the exchange rate actually is between pounds and dollars. Let's say we want to determine how much 1 pound is worth in dollars, okay? And to do this, the value of a pound in dollars, we simply take the value of the pound in rands divided by the value of the US dollar in rands. And then if we divide these two, we get 1.2329. So this means that 1 pound is $1.2329. So the currency that you want to convert to the other one is the one that you put on top. And the currency you want to get, in this case dollars, is what we would put at the bottom. So we get 1 pound being equal to $1.2329. The second last thing you need to note, you need to know about what we call futures and options in the currency market. There are also forward contracts, but your module specifically says you need to know about futures and options. Futures and options are going to be covered in detail with a lot of mathematics. I think in study unit 5, we're still in study unit 3. I think maybe even in the next video, if I can cover study unit 4 and 5 in one video. So futures and options. This is where calculations really start in this module, and you'll find that a lot of the assignment questions are on this, so we'll be able to answer those questions. So you need to know about futures and options in the currency market, right? So futures are dealt with in the futures market, like I was telling you about. So a currency futures contract, we have what we call a currency futures contract, specifies a standard volume of a particular currency to be exchanged on a specific settlement date at an agreed exchange rate. They are bought or sold on an exchange. So let me explain this, because it's really important. You need to understand these contracts. Okay, we have what we call a currency futures contract, and basically this contract is a contract in which you, as the holder of the contract, have the obligation, the legal obligation, to buy or sell a foreign currency on a specified date at a specified amount. Okay, it's just a contract that agrees that if you come at a specific date in the future, for example 3 months from now, the bank or the institution with which you've entered into the contract with will guarantee that they can sell you a foreign currency at a fixed agreed price, or they guarantee that they can buy a foreign currency from you at an agreed and fixed price, irregardless of whatever might have happened in the market. Okay, so it's a way to manage risk for you. It means if let's say, for example, you're a multinational company and you expect to receive $1 million in 3 months, right? But let's say you're afraid that the US dollar will lose value against the rand, meaning when you convert those US dollars into rands, that's a futures contract, right? In which case, one party will agree that come 3 months when you've received the 1 million, they will be guaranteed to buy those US dollars at you at a price you agree today, meaning you won't have to worry about whether the US dollar has lost value against the rand, because you have a contract in which you have a specified agreement with someone for a specified amount, which is not affected by whatever is going on in the market. So that's a currency futures contract. So it's the way to manage risk. On the downside, if the US dollar is actually strengthened when you thought it would weaken, you would be at a loss because you've already agreed at an agreed amount. So it protects you against what might happen with downside risk, but it doesn't. It also prevents you from getting potential benefits because you've locked in at an agreed rate. So if the US dollar actually ends up strengthening, meaning it can be changed into more rands, you won't be able to benefit from that because you've entered into a contract which is a legal obligation. There's no way out of the contract once you enter into it. So here's another example. So you might get a quote on a currency futures which says maybe 3 months from now, we will buy or sell $1 US to you at 19.43. So this means that after 3 months, you can buy or sell, depending on the position that you want to take, you can buy or sell US dollars, right, at a price of 19.43, irregardless of what the spot rate is, irregardless of what anyone else might be paying in the market. So this is an obligation. There is no way out of it. A futures contract is an obligation. You can't get to 3 months and then decide to say, I no longer want to actually sell or buy. Once you enter into it, you have to honor your obligation, right? So it doesn't offer a lot of flexibility, but it does protect against downside losses, but it also limits upside losses because you've agreed what the rate is going to be. So in study unit 5, we're going to look at these futures contracts. They are very, very important, and they make up a significant amount of your, they make up a significant amount of your assignment. Let me put it up here. There we go. They make up a significant amount of your assignment. You see, they talk about futures. They'll start talking about them, forward rates and futures. We'll come across that. And so, like I said, they don't have flexibility, but they have an alternative. We also have what we call a currency option contract, right? So a currency option contract offers more flexibility than a futures contract. It's exactly like a futures contract, but the only difference is that you actually have the choice, not the legal obligation, to buy or sell a given currency at an agreed rate on a specified date. Okay. So this contract has a lot of flexibility. It's got a lot more flexibility than a futures contract because it gives you the choice to buy or sell a given currency at an agreed rate on a specified date, right? So if it's a contract that gives you the right to buy the foreign currency at an agreed rate on a specified date, we call it a call option currency contract. So it's a currency call option. It's a call option on a currency. It means you have the choice. It's up to you whether or not to buy a given currency at a specified rate sometime in the future. And if it's a contract to sell, we call it a put option. This means you have the choice to sell a given currency at a specified date for a specified amount sometime in the future, right? So you actually do pay some money to be able to purchase this call option or put option. That doesn't apply with a futures contract. So you actually purchase an option to be able to buy or sell in the future. That means if it's unfavorable for you to actually buy or unfavorable for you to actually sell, you can choose not to do so. Okay. So these are actually come up a lot in the assignment. You see question 3 when we get to it actually involves these options that we're talking about, whereby if it's a call option, you have a choice, an option to buy US dollars at 1.8040 or to buy US dollars. Sorry, actually it's here. A call option allows the holder to buy 100,000 US dollars. It's an exchange rate of 1.8, meaning each US dollar is costing you 180 in Australian dollars. Okay, so this would be an Australian company. So this would be the rate at which you have an option to buy sometime in the future, and you actually have to pay 50 Australian cents to be able to buy at this rate. But we'll look at this in the next assignment. Yeah, I was just giving in the next or the video after, in the coming lessons. Yeah, I was just giving you a background as to what this call option is or what this put option is. So a call option would give you the choice to buy a given currency at an agreed rate in the future. When it actually comes time to buy the currency, it might actually be higher than what you had agreed to buy it, or it might actually be lower than what you had agreed to. So you can get a choice. If it's favorable for you to buy, it would be favorable for you to buy. If it's actually higher for everyone else, then you can buy at 180 rather than buying for these amounts. But it would be unfavorable for you to buy at this rate if everyone else is paying 1.787. That way, you just won't choose to exercise your option and you'll buy in the spot market at this price. Okay, so we'll go through this for now. I just wanted you to understand what we mean by a currency option contract. It's a contract giving you the choice to buy or sell a given currency at a specified rate in the future. Call option would be a contract to buy, where you have a choice, and a put option, a contract to sell. And then lastly, in study unit 3, you need to know about 5 types of markets. We have what we call the international money market, and this is the market in which corporations can borrow short-term funds to support their operations. So let's say a company wants to borrow money for less than a year just to support their day-to-day operations, and they want the money in a foreign currency or even in their domestic currency. They can borrow the money in the international money market, maybe through banks or other investors. Then we also have the international credit market. This is the market where corporations can also still borrow, but they borrow in the medium term. Usually that's maybe if you want to borrow money for between 2 to 5 years, and maybe the money is in a foreign currency and you need the money to meet your financing needs. Maybe 2 to 5 years, you borrow that money in the international credit market. Then we also have the international bond market. This is the market in which corporations can borrow long-term funds. This would mean you're borrowing money for more than 5 years, maybe 5 to 10 to 15 years. And maybe the money is in a foreign currency. So we call that the international bond market. We also have a very important market called the Euro bond market, which consists of the issue of what we call Euro bonds. So these are some words you can come across. And these are bonds that are sold in countries other than the country of the currency denominating the bond. Bonds that are sold in a country other than the country of the currency denominating the bonds. For example, if you are a South African company and you sell bonds denominated in US dollars in Japan, meaning you're a South African company that goes to raise US dollars in Japan, we call that a Euro bond, because firstly it's denominated in US dollars and is being issued in a country which is different from the currency in which it is denominated. We call that a Euro bond. Okay. And lastly, we have the international stock share market. And this is the market in which corporations can raise finance internationally through shares, through equity. So if a company wants to raise money through shares in the international market, they go to the international stock market. Okay. So that brings us to an end of study unit 3. I hope this video has been helpful. In the next study unit, we'll look at study unit 4, and hopefully we'll also be able to start on study unit 5. But if we don't have enough time, it will just be study unit 4. And then we should also start looking at some questions from the assignment. So this is what study unit 4 covers on. It looks at exchange rate determination. How do we actually determine those exchange rates we were talking about, right? And then study unit 5, which is really important and contains a lot of mathematical aspects, is where we'll look at forward markets and futures markets. A forward contract is just like a futures contract, but a futures contract is bought or sold on an exchange by a financial institution like an exchange, whereas a forward contract is a private contract between two parties. But I'm going to take you through all of that. So study unit 5 looks at forward contracts, and then study unit 6 I think looks at central banks and other aspects and so forth. Okay, so study unit 5 is where most of assignment 2 is based. Okay, so thank you very much for listening to the recording. I hope it's been helpful. So we'll pick it up from there. And if you have any queries, please feel free to let me know. I hope this recording has been helpful. Thank you.